So PCE's coming out. We were just showing the headline numbers just now. You know, here on CNBC, a lot of people in the market, we cover just every cough and spit. We try to get any insight to what this could mean for the Fed, but I don't think you're doing that. You think we're getting a cut in June, we're getting 4 cuts this year. So in your mind, is PCE actually that important?
You know, probably not. I mean, it is in a sense that it's an important data point in an economic environment where inflation is the key driver. But at this point, you know, the market expectations for the Fed are right in line with their December SEP. We're probably not getting cuts or anything on QT until later this year anyway, when there will be plenty more data on whether inflation is sticky or just having a sticky patch. So it's not that it's not an important data reading here. It's very important just to get a better sense of things. But as for the Fed, I think it would have to really surprise to the upside, which is not totally out of the question for them to actually change how they're thinking.
All right, so since that hotter than expected CPI read, it was a case where kind of, I guess, bad news was good news, at least if you're a fan of the broadening of the market. So since that CPI read, we've really seen the market broaden out. So in your mind, if this PCE number comes in hotter than expected, what does that mean for the markets?
If it comes in quite a bit hotter than expected, it's probably near-term risk off, not all that different from CPI. And you might see that. But to your point, right, the market has broadened out in spite of the fact that it's taking Fed rate cuts off the table. To me, that's a very, very bullish signpost that the market is broadening, the economy is remaining pretty resilient, despite the fact that rates are likely to remain restrictive for the rest of this year.
So, Ross, I want to bounce something off of you. I know you're a big fan of cyclicals right now, specifically industrials and consumer discretionary. Consumer discretionary is actually leading this week, but new note from Fundstrat last night. I want to get your take on this. According to Mark Newton, he says this mild consolidation should represent a buying opportunity for a push higher into mid-March before any consolidation sets in. And he adds, it's very possible that the triple Qs could lead the markets higher. That's the NASDAQ 100, of course, mega cap tech. Agree or disagree?
I'm definitely more in that camp than not. I think consolidations and corrections are viable. I think cyclical leadership remains, whether it's in the tech and tech adjacent consumer space or whether it's in something like industrials. But yeah, I'm leaning into cyclicals. I'm buying on consolidations, and I think the economy remains pretty strong for the rest of the year.